Hi, I'm Rick Kaler. Thanks for joining me. Have you ever stood on a ladder painting a wall or trimming a branch and then suddenly realized just how far down the ground is? Even if you know the ladder is steady, you might just wobble for a moment. Well, that's what investing can feel like when markets reach new highs. September was one of those months, and October continued the trend. At the end of September, the S&P had a trailing price to earnings ratio of around 30. This is really high, and it was elevated relative to long-term norms, though it's still below the extremes seen at other peaks. Yet instead of falling, nearly every investment category delivered gains. Broad U.S. equity indexes, as captured by the FT Wilshire 5000, ended the third quarter with a near record high, reflecting continued positive returns across most asset classes. Large caps mirrored that strength, with the S&P up about 13.7% year to date through September. The NASDAQ composite rose roughly 17.3% on the year through the end of the quarter. International markets were strong as well. Developed markets, measured by the MSCI EAFE index, were up about 21.1% year to date. While the emerging markets, that would be China, Korea, Taiwan, and others tracked by the MSCI Emerging Markets Index, gained about 27.5% over the same period. So, pretty rosy picture. Still, there are reasons for caution. Inflation is edging higher, job growth has slowed, and the bond market remains inverted. Add in the government shutdown, and the signals are mixed at the very best. The U.S. economy's rebound in the second quarter was stronger than first reported, yet some economists warn that as much as a third of the country may already be in recession, while another third has stagnated. Others caution that continued tariffs and trade disruptions could tip the economy toward contraction. So at times like this, our internal financial system kind of comes alive. Inside us are different parts that react to the same market in opposite ways. A risk-taking part may feel emboldened by the gains and want to buy more. Another part that is cautious remembers 2008 and says, you know what, maybe you better sell before the inevitable happens. Both parts of us mean well. The risk taker seeks opportunity while the worried part seeks safety. But if we let either one take over, we risk a lot of regret. So to avoid that takeover, when you feel that internal wobble, pause. Notice which part is speaking and ask it to step back so yourself, the calm, clear, wise adult in the room, can take the lead. The self knows that markets aren't moral. They're simply cyclical. It understands that fear and greed are natural human responses, not investment strategies. In truth, downturns are not a matter of if, but when. A recession is going to come. The market is going to correct. And history shows that long-term investors who stay invested through the full cycle tend to come out ahead. If you have an attack of nerves while you're on the ladder, neither scrambling down in a panic nor reaching recklessly higher is going to serve you well. The best approach is to plant your feet, steady your balance, and trust the rung beneath you is not going to give away, which high probability it will not. The same applies for an attack in Earth triggered by the market highs. Building a solid structure requires creating a financial plan anchored in your needs, your timeline, and your tolerance for risk. So this includes keeping short-term funds in safe places and allowing the rest to ride through the inevitable ups and downs. You may want to revisit your allocation to confirm that it still matches your goals in your time horizon. Refill any depleted cash reserves. Automate contributions so your savings plan doesn't wobble with the alarming headlines. And if a risk-taking part or a fearful internal part starts shouting for control, thank them for their good intentions. They don't mean harm. And then remind them that good plans, like sturdy ladders, are built to withstand both overconfidence and fear. Thanks for listening.